Number one, I really think alignment matters. When David and I sit at a credit committee, we think about two things. We think about, is this a good investment for our money, our capital? And then we have reputational risk as well. We're dealing with 3,000 investors who we take that responsibility very seriously, and we sit at that table thinking about them. And I think in the larger organizations, sometimes there's a disconnect between your investment partner and your management company, and there's not always interests aren't aligned, right? There's conflicts in those situations. So I think it starts there, but then it extends to, how are we building our firm? How do we think about risk management, right? So risk management to me is all encompassing, and it starts with who we hire. How do we incentivize them? How do we align our interests internally? Extends to strategy. Where do we invest? How do we want to invest our money? And what we've done is we've sort of taken a national approach and said, we want to see a lot of deals, right, in different markets, but in the growth markets. We could invest in Chicago. We choose not to here. We could invest in industrial. We choose not to, because we believe that specializing in a single asset class will make us better and produce better returns for our investors in the long run. So it's not any one single answer, but I would say that bringing this into the room and thinking about this holistically, around how we're managing money. And also, what I tell people is that if you're in our credit committee and you're listening to a deal and listening to one of our acquisition officers present the deal, you get it. You're like, this makes a lot of sense. I understand it, because there's about 5 or 6 variables that really make sense, right? We've already chosen the markets. We know the sub-markets. We know the demographics that we're going after. So those are sort of, the guidelines. And our team is really, really good at understanding real estate, where the growth is going to be. And so when we're underwriting and we're looking at these projects, and you look at rents and you say, okay, we're going to build a project. I'll just use a development as an example. And that project isn't going to be delivered for about 3 years. And we're looking at our rents in 3 years against today's rents. And we say, okay, in 3 years, our rents, we need to achieve a $1,700 per unit, right, on average. And we're looking at the comps today. And let's say inferior properties are trading, $1,650 or $1,600 per unit. You can look at that and say, that's really believable that we're going to achieve $1,700. Or I'll take it in reverse, right? Generally, what we're looking at is the equal or inferior properties are producing higher rents today than what we're going to achieve in 3 years, right? And so you're looking for those opportunities. Where are there other ways to win, right? Where is there more meat on the bone? Where can we underwrite conservatively? Because we're not ones to set new high watermarks in any market, right? We don't look at the market and say, hey, we're going to build this and the high watermark is $1,800 per unit and we're going to get $2,500. There are some developers who do that. That's not us. The other thing we do that has protected us over the years is we drift cap rates. And so, in this crazy frothy environment, when cap rates were trading below 3.5, 3.25 in some markets, all of our deals were presented with a starting cap rate of 3.75 to 4, depending on the market. And today we're absolutely at 4. But more importantly, the exit cap rate in 3, 4, 5 years, we drift that. We drift that up over time to account for the unknown. And when you do that, those are best practices in all of institutional underwriting. And if the deal can withstand conservative rents and cap rates that are drifted, right? If we're exiting at a 4.5 cap and today is 3.75, we don't know where cap rates are going to be in the future, but we know that we're protected. So if they do go up to 4.5, it's already in our underwriting. And so 1,000 variables that can influence real estate. And so on the front end, you got to make sure that all of your inputs are being calculated accurately and conservatively. And I think that's something that has really helped us.